Hi there, my name is Andrew Cohen, and these are my colleagues.
I'm Susan Olayari.
I'm Jorge Gonzalez.
And I'm Nicholas Nesperos.
And we are
Top Tier Investments.
An overview of our analytical process to determine purchasing price, to generate our discounted cash flow analysis and sensitivity analysis, provide an explanation of our assumptions, and explain pros and cons of our recommendation is as follows. First, we begin by researching current market conditions, economic standing in our property's location, and historical data helping us to forecast real estate trends and rates for the next 10 years. This was followed by creating a discounted cash flow, or DCF. The discounted cash flow analysis encompasses all assumptions made from our research, all income, both potential and effective, all expenses, and all calculations helping to determine our recommendations. Lastly, after analyzing the current market, our property's pros and cons, and our DCF, our team concluded on a series of recommendations to our favorite client, Ray Kalman. The property is located at 14429 Dickens Street, Sherman Oaks 91423, just south of Ventura Boulevard, west of Beverly Glen. It is located on a 6,742 square foot lot, and the building itself is 3,495 square feet. Its listed value is $1.8 million. The building consists of 5 one-bedroom, one-bath apartments, 4 single-stall garages, and 1 on-site laundry facility. The building was built in 1951, so it is under rent control.
Here is an overview of the rates we used for valuing this property after extensive research of historical data. Through this report, we will guide you how we came up with these rates. The income growth rate of 4.5% has been used due to the rent control, and in case of vacancy, our price jumps to the market level. The high demand in Sherman Oaks leads to rent charges higher than the average in the Los Angeles County. The expense growth was determined according to the Rent Stabilization Ordinance. The annual rent increase adjustment shall be based on the Consumer Price Index, which is 2.3%. Our team concluded on a 4.25% terminal capitalization rate by reviewing the Multifamily Research Market Report and the CBRE North America Cap Rate Survey. The cap rate is lower since this property is located in the metro core, and this building is a stabilized asset due to the rent control and desirable location. Our team dove deeper into the historical data of the NCREIF Property Index provided by the CBRE, which revealed that commercial real estate market has an average return of the last 10 years of 7%. This data also showed a decline of 39% over the last year. We believe that the investment rate of return will continue to decrease, therefore our team concluded on a discount rate of 7%. The vacancy rate used was 3%. The low vacancy rate is due to the fact that the property is subject to rent control and its great location. Another factor is that more millennials get into their late 20s and early 30s, and they will begin to drive the demand for multifamily rental properties higher due to the fact that they are delaying major life decisions such as marriage and home ownership.
Our team recommends using a 10-year interest-only loan with a loan-to-value ratio of 75% to purchase this property. Using this ratio will result in a down payment of $414,000 and a loan amount of $1.2 million. There will only be interest payments of $47,244 annually until the end of year 10, when a balloon payment of $1.2 million will be due to pay off the entire loan. With an investment like this, it is smart to reinvest the extra annual cash flow. Our team of analytics researched different reinvestment options to invest the annual cash flows in, such as bonds, stocks, mutual funds, and a few other options. However, we want to keep risk low, so we suggest investing in short-term U.S. bonds. These are the safest investments available to investors today. The 10-year average of Treasury bond yields currently sits at 2.56%, and based on this information, a reinvestment rate of 2.56% is safe to assume. The annual income coming in from this investment is from monthly rent from 5 units, which brings in about $95,000 in the first year, and will grow to $144,000 by year 10. Also, there is an on-site laundry room that brings in a notable $3,000 in year 1, and by year 10 should bring in about $4,500. After we account for a possible vacancy, which is at 3%, we come up with an effective gross income of $95,000 for year 1 and $144,000 for year 10. Next, we have our expenses. The expense on this property are pretty uniform and standard for the Sherman Oaks area. We have electric, insurance, landscaping, maintenance, management, miscellaneous, property tax, and water expense. The property tax was calculated using a 1.25% tax rate with a 2% growth per year, which is the maximum allowed by law. After subtracting our expenses from the effective growth income, we end up with a net operating income for year one at $54,131 and a net operating income at the end of year 10 of $2,380,938. The year 10 net operating income is way higher due to the sale of the property and our income growing faster than our expenses. Interest and depreciation are important since we can deduct those expenses to lower the taxable income. Depreciation will be based on the improvement value only, which we calculated to be 60% of the current market value. This results in an annual depreciation amount of $36,168. And as I said earlier, we will also pay $47,244 in interest annually. Both of these expenses will decrease our taxable income by $83,000 each year.
Taxable income takes the net operating income and subtracts the sum between depreciation and interest payments. As previously mentioned, the depreciation comes from the improvement value of 60% and not from the value of land of 40%. The interest payments are from our interest-only option. The depreciation amount stays constant between year 1 and 10. The interest amount stays constant as well. Both of these amounts are subtracted to the net operating income, which accounts for the effective gross income and expenses. Taxable income changes from negative value to a positive from year 1 to year 10. After-tax cash flows then considers tax and interest. The current tax rate is 23%. The interest payment from the interest-only loan is included to our final amount. In addition to the interest and taxes, year 10 includes the balloon payment summing the remaining loan amount. The 1031 exchange is beneficial for the sale of the property in year 10 as it provides you, the investor, a benefit of $342,935. Altogether, year 10 accounts for an after-tax cash flow just over $1 million. Partitioning sets cash flows from operations and from sales apart. After-tax cash flows consider the internal rate of return to measure the present value of the holding period. Operations accounted for 27% and the sale of the property for 73%. Based on these percentages, the investor can compare the partitioning of this property with other property of interest. The higher the percentage of cash flows from the resale, the riskier the investment. Duration measures the magnitude and timing from partitioning. The size and timing of receiving cash flows are considered and have a direct correlation with duration. The duration for this project is 1.73 and it exposes interest rate risk after using a $414,423 down payment. The weighted average time is fairly low given the 10-year holding period.
Our sensitivity analysis takes a close look at how sensitive both the internal rate of return and the modified internal rate of return are to fluctuations in the discount rate. As we can see from these two tables, both the internal rate of return and the modified internal rate of return are very sensitive and are affected substantially, even when the discount rate only changes slightly. We also considered how our modified internal rate of return was affected by changes in the reinvestment rate and borrowing rate. For the modified internal rate of return, we see that a variation in only one of these rates does not have a big impact, and that only on the far ends of the spectrum, or the reinvestment rate is very low and the borrowing rate is very high, or vice versa, is where we see a change in the modified internal rate of return. Our final recommendations and conclusions for this investment property are as follows. Our analytical team recommends a purchase price of $1,657,690 with a down payment of approximately $414,000. To finance this project, we also recommend a 10-year fixed-rate interest-only loan of the remaining amount and a balloon payment to pay off the entirety of the loan at the end of the 10-year holding period. Our modified internal rate of return was concluded at 12.27%, and our internal rate of return was determined to be 13.23%. Lastly, we recommended our client, Ray Conlon, to utilize the 1031 exchange to avoid any capital gains tax. Thank you for your time and attention. If you have any questions or concerns regarding this investment, please do not hesitate to call or email Top Tier Investments.
I think we're good.
Cool.
Yeah,
All right,
we can
stop the
talk.
recording.